Understanding Risk-Adjusted Return, a comprehensive guide. The concept of a risk-adjusted return is fundamental in the world of investing. It serves as a crucial metric in assessing the profitability of an investment while factoring in the level of risk involved. Recognizing how much risk an investor is taking for a particular return can lead to smarter investment decisions. Let's delve deeper into what risk-adjusted returns are, the various methods used to measure them, and key considerations for investors. What is risk-adjusted return? A risk-adjusted return refers to the profit made from an investment after considering the risk associated with it. Unlike simple returns, which only look at profit without accounting for risk, risk-adjusted returns provide a clearer picture of an investment's performance relative to its risk. Generally, the performance is compared to a virtually risk-free investment, such as U.S. Treasury bonds. Investors use this metric to understand whether the potential rewards of an investment justify the risks taken. For example, if two investment options yield the same returns, the one with lower risk is preferred, indicating a better risk-adjusted return. Key takeaways. 1. Measurement of performance. Risk-adjusted returns evaluate an investment's returns considering the risk taken, helping to determine whether the expected reward is justified. 2. Different methodologies. Various methods exist for evaluating risk-adjusted performance, such as the Sharpe and Treynor ratios, alpha, beta, and standard deviation, each offering a unique perspective. 3. Comparative analysis. Investors should consistently apply the same risk measures across different investments to facilitate fair comparison. Popular methods for measuring risk-adjusted returns. Sharpe ratio. The Sharpe ratio measures the excess return on an investment above the risk-free rate per unit of risk, standard deviation. The formula is \text Sharpe ratio equals \frac r r_f \sigma where r equals return of the investment. r_f equals risk-free return, often the yield of the 10-year treasury. \sigma equals standard deviation of the investment's return. Example. Consider two mutual funds. Mutual Fund A, 12% return, 10% standard deviation. Mutual Fund B, 10% return, 7% standard deviation. Risk-free rate, 3%. Calculating the Sharpe ratios. Mutual Fund A \frac 12%, 3%, 10% equals 0.9 \. Mutual Fund B \frac 10%, 3%, 7% equals 1.0 \. Despite a higher return from Fund A, Fund B is more appealing in terms of risk-adjusted return. Treynor ratio. The Treynor ratio also assesses performance but uses beta instead of standard deviation in the calculation. \text Treynor ratio equals \frac r r_f beta \. Example. Using the earlier mutual fund example and a beta of 0.75 for both. Mutual Fund A \frac 12%, 3%, 0.75 equals 0.12 \. Mutual Fund B \frac 10%, 3%, 0.75 equals 0.09 \. Here, Fund A earns more return per unit of systematic risk. Other risk adjustment measures. Alpha represents an investment's return relative to the return of a market benchmark, indicating how much an investment outperformed or underperformed. Beta compares an investment's volatility to the overarching market. A beta greater than 1 indicates higher volatility than the market. Standard deviation gauges the investment's return volatility, with higher values indicating more risk. R-squared measures how closely the investment's performance aligns with the benchmark index, revealing the degree of correlation. Special considerations. When evaluating risk-adjusted returns, it's essential not to demonize risk entirely. Strategies that appear overly conservative might limit potential gains. In dynamic markets, investments that carry more risk often yield higher returns over time. Recognizing market cycles and understanding how higher-risk investments can outperform is vital for long-term success. Common questions. What are the primary measures for risk-adjusted return? The most frequently used metrics include the Sharpe ratio, alpha, beta, and standard deviation. Is risk-adjusted return synonymous with the Sharpe ratio? No, the Sharpe ratio is one of several methods to measure risk-adjusted returns. How can risk-adjusted return be calculated for real estate? Investors can apply traditional measurements by assessing property returns and standard deviation against relevant benchmarks like the 10-year Treasury. The bottom line. Risk-adjusted return metrics are crucial for investors who seek to understand investments beyond surface-level returns. By employing various measurements, investors can evaluate their portfolio's performance more comprehensively, balancing risk and reward effectively. Understanding these concepts equips investors with the knowledge to navigate the complex securities market, ultimately leading to informed and strategic investment decisions.